Welcome to Dig Deep, the mining podcast. In this podcast, we go deep into mining news, hot topics, and live interviews with mining professionals and leading figures in the mining industry. Introducing your host, Rob Tyson, founder and director of Mining International and Mining International Executive, a leading global mining recruitment and headhunting agency.
Hi, mining community. Welcome back to another episode of the Dig Deep, the mining podcast. And today we have a returning guest who appeared back in September 2020, which was 3 years ago, which was episode 98. David Garofalo, who's an experienced C-suite executive with over 3 decades in the precious metals space, and is the former president and CEO of Goldcorp. David's passionate and focused in the creation of growth of multi-million-dollar sustainable mining businesses across multiple continents, and is the CEO of many companies, including Gold Royalty Corp, Marshall Precious Metals Fund, Gold Mining, and Arias Gold Corporation. And he's here today to talk about obviously the various companies that he's involved in, monetary policy, the inflation life cycle, mining equities. So there's generally a lot of topics we're going to cover and obviously unpack. So let's welcome David back to the podcast. How you doing, David?
I'm delighted to be here. Thanks for having me on, Rob.
No, I appreciate your time as well. Obviously, for those that didn't listen to that episode 3 years ago, obviously I remind you to go back and have a listen to that. But for those that didn't listen to that episode, just wondering if you just give us a quick, or not necessarily quick, just an overview of yourself and your career. Obviously, since you graduated through to sort of present day.
Yeah, it's approaching now 35 years in the mining industry. Though I'm an accountant by training, I joined the base metal business back in 1990, a company called Inmet Mining, built several mines there in the copper complex. Before I joined Agnico Eagle in 1998 as chief financial officer, I spent 12 years there, and we built 6 mines in the 12 years I was there as well. Then took over as CEO of Hudbay Minerals back in 2010. I ran that for close to 6 years, building several mines there as well on the copper complex again, and then joined Goldcorp in early 2016. And that culminated with the merger with Newmont in 2019 to create the world's biggest gold company by market cap and production. And then I founded, along with my partner, Amir Adnani, Gold Royalty Corp back in 2020, which we took public in 2021. And we've grown our business 15-fold since we IPO'd in 2021 through the acquisition of some of our peer companies and through investment in new royalties. So it's a royalty, precious metal royalty focused company with over 220 assets in the Americas.
Yeah, so I just wondered if obviously you can give us an overview, obviously, of all the companies that you are sort of involved in. Obviously, Gold Royalty Corp and Gold Mining and Arias Gold Corporation. Just wondering if you give us a snapshot of obviously the companies that you're involved in.
Sure. So Gold Royalty Corp is singularly focused on precious metal royalties. Almost all of the assets are in the Americas currently, though we're looking broader geographically for new royalty opportunities. As I said, we've grown very, very quickly, raised $90 million in our IPO back in 2021, and have grown our royalty portfolio 15-fold through rolling up some of our peer companies. We bought 3 companies back in 2021. And also acquired a number of other royalties through third-party royalty acquisition, through project financing, generating our own royalties organically as well. I serve also as the co-chairman of Gold Mining Inc. That's the former parent company of Gold Royalty Corp. So we were spun out of Gold Mining Inc. back in 2021 in our IPO with royalties on Gold Mining Inc.'s assets. And Gold Mining Inc. has a collection of about a dozen development stage gold assets throughout the Americas with about 32 million ounces of gold equivalent on them. And I also serve on the board of Arias Mining. Arias has 2 Colombian operations in the gold business, approaching 500,000 ounces a year of production. I'm a non-executive director on that board, and a number of development stage assets throughout Latin America that provide growth for many, many years to come. And then finally, I founded a precious metal fund in partnership with Zijin Mining out of China, Zhaojin, back in 2019, investing in early stage exploration opportunities under the thesis that, eventually there's going to be a rotation of capital back into the junior space, which has seen significant underinvestment, and there's been a lack of discoveries in the gold business. As a result, we've seen about a 40% decline in reserves across the gold industry since 2012. And so inevitably, you're going to see a rotation of capital back into exploration, and we think the juniors will do extremely well in that environment.
Yeah, obviously you've been in the gold space for quite a few decades. I get a lot of listeners, or majority of my listeners are actually people from the mining industry, so mining professionals, no matter whether they're engineers, geologists, processing, maintenance, etc. And I just wondered what your take is on why you should own gold if you were to look to invest in gold, whether you look at obviously shares in companies or even take physical delivery of gold. What's important about individuals in owning gold?
Well, I think what it does is provide you insurance against the debasement of fiat currencies, which we've seen happen continuously, really since the early 1970s, when the US dollar was decoupled from the gold standard. And there's been a competitive devaluation of fiat currency since that point, because fiat currencies became unmoored from anything physical, substantive, and gold has been the ultimate currency for 4,000 years, very finite quantity. So there's been a prolific printing of fiat currencies globally. In fact, the purchasing power of the US dollar since it was decoupled from the gold standard in the early 1970s is down 90%. So as you can imagine, that paper has become much, much less worthy since really the decoupling from the gold standard. And we've seen that competition to debase currency to preserve export markets occur globally. It's a phenomenon that occurs across the industrialized world, and it continues and accelerated during the great financial crisis in 2008 when we saw massive monetary expansion. And now we're seeing the excesses of that, or the evidence of the excesses of that, in the current economy with massive inflation. Headline inflation severely understating the reality on the ground. It's inevitable that hard asset prices will go up in the face of that type of printing of fiat currency. So gold is the one currency you can't print. It's very finite in quantity. We produce very small amounts of it as an industry every year. We don't have the elasticity of supply to price. So as the gold price goes up, we haven't actually seen an increase in gold supply. We've actually seen a deterioration in gold supply because of the significant underinvestment in exploration that I alluded to a little earlier on. The juniors haven't had access to capital for a long period of time, and they're the ones that do all the heavy lifting in exploration to find new ounces in the ground, new deposits, and they simply haven't had the capital to do that. So we have seen a very bullish scenario paint itself really since 2012, with a 40% decline in reserves, a continued debasement of fiat currencies. Gold will shine in this environment as inflation continues to accelerate and becomes quite deeply entrenched into our economy.
And obviously, you mentioned about the junior miners. Have you seen over the course of the last year or two more money coming into those gold mining juniors, or is there still reluctance to put money into the industry? And how do you see that playing out?
In my entire career, I've never seen this type of disconnect between where the commodity price and where equity valuations are. I've seen equity valuations worse. I could go back to late 1990s when I started with Agnico Eagle and gold was $250 an ounce. The valuations were very depressed then. It was a very unloved sector. But we have gold at close to $2,000 an ounce right now, and the valuations are severely depressed. They've gone in the opposite direction of gold. So there's been a flow of capital out of the mining equities, in particular the junior sector, which has seen a significant deterioration in valuations over the last year or two. It's a very narrow equity market. So yes, the general equity markets are up, but it's narrowly focused on the 7 largest cap technology companies in the world. The rest of the equity sector, or the general equity markets, are suffering miserably, and the juniors in particular lack liquidity, lack access to capital, and therefore lack the ability to explore their properties. That's where we're going to see a continued steady downward trajectory in reserves, gold reserves in the ground for many, many years to come.
Wondering if you could talk about obviously monetary policy. Obviously, interest rates are increasing to unprecedented levels for the general public, combined with increasing inflation. How do you see this sort of playing out going into 2024 and beyond?
I think the interest rate tightening cycle is done. And I would say was largely irrelevant anyways, because inflation continued to accelerate. So yes, nominal rates were going up, but real interest rates were flat to declining in the face of that. And that's why we've seen gold hold in so well against the US dollar. It's still near its all-time highs of, almost $2,100 an ounce. And gold is at all-time highs in every other major currency in the world. That's reflective of the fact that monetary policy is not tightening, it's continuing to ease. And it necessarily needs to, because debt levels globally are at 350% of GDP relative to where they were back in the 1970s and last big inflation cycle when they were 100%. So we have 3.5 times the debt level as it relates to GDP globally than we had back in the last inflation cycle in the 1970s. Why that's important is because it tells you how limited the central banks are in terms of really tightening real interest rates. Because if they did that, they would bankrupt their governments, given the absolute amount of debt strapped on globally. So there's a limit to what they could do in terms of tightening nominal interest rates. They're certainly not going to tighten above the real rate of inflation, which is well in excess of what the headline numbers are. It's deep into double-digit territory. And so real interest rates will continue to decline. And the correlation, the negative correlation between the gold price and real interest rates over time since the early 1970s is stark, striking. It's near 100%. And so you're going to see a continued increase in the gold price in every major currency as the Federal Reserve and other major central banks start to pivot on nominal interest rates. Inflation continues to accelerate. And they want inflation to accelerate because they can't repay the debt. They're going to have to inflate it away.
And obviously recently, obviously the time of recording this, which is in September, they've obviously had the BRICS meeting recently between Brazil, Russia, India, China, and South Africa. What can you conclude from their sort of recent meeting in Johannesburg that happened the other week?
Well, they've been making noises for quite a while about creating an alternative reserve currency to the US dollar. I'd say good luck. Because it's just another fiat currency. It's just one piece of toilet paper replacing another piece of toilet paper, quite frankly. And the reason I say that is because paper's paper, and particularly in countries that are horribly corrupt, top to bottom. Why would anybody buy a reserve currency in any one of those countries? Brazil, Russia, India, China, South Africa. They have significant infrastructure deficits. They have corruption, lack of rule of law. Why would anybody own a reserve currency in any one of those economies? So yeah, good luck creating an alternative reserve currency that nobody wants to own. The only reserve currency that exists globally and has for 4,000 years is gold.
And how would you like the currency, or how would you like the monetary system to be, if there was a new one to be implemented? How would you like to see that being, I suppose, made up of? Obviously gold, but how would it work?
Look, I don't think we're going to go back to a gold standard. I don't think that's practical. But what I am seeing, and there's hard evidence of that, is central banks are buying gold as quickly as possible because they recognize that real interest rates are deep into negative territory. So there's no opportunity cost to owning the one true currency, which is gold, which can't be manipulated. So you look at the developing world, including the BRICS economies, they're buying gold as quickly as they can into their reserves, their central bank reserves. To mitigate the debasement of their own fiat currencies and the debasement of the US dollar as well. And so I think you're going to see that trend continue. And I think what that does is really create a universe where the countries that have strong gold reserves are going to have the strongest fiat currencies.
Obviously, you work in the junior gold space. What are some of the challenges, apart from, I suppose, finance? What are some of the challenges the gold junior market is sort of experiencing globally?
Well, it's just a massive retrenchment. They haven't had consistent access to capital. Maybe the one exception being Australia, which has access to capital through their superannuation pension system. But if you look at the rest of the world, particularly Canada and the UK, which has been consistently a market that's allowed juniors to raise capital, it's been a nuclear winter for almost a dozen years or more, where juniors have not had consistent access to capital. As a result, their exploration budgets have been inconsistent, and they haven't been able to invest the necessary capital in new discoveries. That's why we've seen this 40% decline in reserves since 2012, is because the juniors who do all of the grassroots exploration, they simply do. The producers really don't do grassroots very well. They haven't had the capital and the budgets in order to do the necessary work at the ground level to make major new discoveries. So I think, as I said, you're not going to see a reversal of that downward trajectory in reserves for a long period of time, because from discovery to first production is typically 15 to 20 years. And so we're in this irreversible downward decline, at least in the short to medium term, in our reserves and ultimately our production. And that's why in the producer side of the universe, you're seeing this cannibalization occur. There's been massive M&A. Most recently, the biggest has been Newmont and Newcrest in the producer side, because if you can't find it in the ground, and they're going to have to replace it through mergers and acquisitions to sustain themselves. It's become an existential imperative for them to merge to sustain themselves as corporate entities.
And where do you see the capital coming from into the gold space? Will it be from other industries? Could it be, say, from pension funds? Or can it actually come from some of the bigger mining companies to invest in the juniors?
Yeah, look, I think there is some of that investment going on by the bigger companies, not consistently into the juniors to provide them budgets and some of the more promising properties, but it's not a consistent source of capital. The juniors need access to traditional equity markets in order to sustain their budgets more consistently. And I think that capital will come when we start to see some momentum in the commodities. Gold and the metals complex generally are at reasonably absolute high levels of prices. Gold near $2,000 an ounce, copper near $4 a pound, zinc over $1 a pound. These are good absolute levels of pricing. But what we lack is momentum to attract that generalist investor. So when we start to see sustained momentum in the commodity price, you're going to see some of that generalist capital come in from pension funds, mutual funds, sovereign wealth funds and whatnot, invest in the commodity space more consistently. And that will allow the specialists to start to raise some money as well. And the specialists have been facing significant redemptions over the last little while. So haven't had an inflow of consistent capital. Once we start to see that flow of capital from multiple sources, then we're going to start to see the equity valuations sustain themselves, and we're going to see more consistent budgets and expenditures from the juniors in the space.
And how do you see the gold industry playing out among some of the mid-tier, or even, I suppose, mid-tier, top-tier mining companies? Do you see sort of further acquisitions within the industry?
Yeah, continued consolidation is inevitable. And it's simply driven by the fact that every one of the major producers are facing declining reserves and production profiles. And so they're going to have to merge with each other to realize synergies on the G&A cost side, and also sustain production and reserve levels and maintain a reasonably diversified portfolio of operations. So there'll be more of the same. There's been a lot of consolidation really since 2018. It started with Barrick and Randgold and Newmont and Goldcorp and a number of others. Kirkland Lakes disappeared. You've seen Yamana disappear. And now you're seeing Newcrest disappear into Newmont. 4 short years after Newmont completed the Goldcorp merger, they weren't able to sustain the production levels they thought they could through the Goldcorp merger, so they've had to do Newcrest to get back to even in terms of their production levels. That's going to be a recurring theme going forward until, as I said, the juniors have consistent access to capital and start to make some major discoveries. Because this is a zero-sum game at the end of the day, M&A. As long as the pie keeps shrinking, there's going to be more of an imperative to do M&A to sustain production and reserve levels.
You've obviously grown many mining companies, and obviously more focusing on the gold sector. What are some of the sort of hidden secrets as to how you would actually grow a mining company? And obviously you've been successful in doing that. What are some of the tips that you could give someone that is maybe working in that junior space that want to develop a mining company?
Yeah, there's no substitute for drilling and building. That's how you create value in our business. It's finding something on the ground that people didn't know existed before, and then building it up through application of your balance sheet capacity or technical capacity as an operator. And that's how you create values, de-risking those large reserves and creating production from them. That's how you create value in the mining business. The rest of it is just trading dollars, quite frankly, M&A included. You need to find things in the ground and de-risk them. And what the juniors need to do is basically husband their resources and wait for the markets to come back. And from time to time, look at non-traditional sources of capital for promising properties. And that's why I'm running a royalty vehicle today, is I think it's a very, very tough road to hoe to build new operations. Access to capital is very difficult to obtain. And what I'm trying to do is provide a consistent source of capital for the explorers, the junior developers to help build their operations out. In an environment where costs are inflating, reserves are declining, creating value is very, very difficult in that business. And what we're trying to do is provide them capital in order to do that.
How do you see the gold mining space play out over the next sort of 2, 3, 4, 5 years?
Yeah, I think it's continued cannibalization and continued merger and acquisition activity for two reasons. One is, as I said, to sustain declining production levels, sustain declining reserve levels, help them get back to even, but also to maintain relevance for the generalists in space. So when the generalist capital comes back into the sector, they're going to be looking to the largest cap names first, the ones with the most liquidity. And so that's where you're seeing merger and acquisition activity at the top end of the food chain, is they're trying to create that scale and relevance that will attract that incremental generalist dollar when it comes back into the sector in a meaningful way.
And lastly, just wondering if you can sort of give us a conclusion around some of the companies obviously you're involved in over the sort of next 6 to 12 months going into 2024.
Well, if there's a recurring theme among the companies that I'm involved in, whether it's the royalty vehicle, whether it's gold mining, whether it's Aris, these are all development-rich stories. The royalty company provides capital to those development stories. The Aris has a number of projects in development within its pipeline. Gold mining has a dozen development stage assets. And Marshall's is focused on investing in the junior end of the sector, where there's exploration and mine development occurring. And that's where I think capital needs to be concentrated because of the significant necessity within the mining sector for new projects, for exploration stage projects, for development stage projects to populate pipelines that are very, very empty right now. That's why reserves are declining and production is declining. The sector is underinvested in that end of the food chain for too long. And so I do believe there's going to be a wave of capital as the gold price gathers momentum into those earlier stage opportunities out of existential necessity for the sector. It needs to grow back. It needs to grow back what it's been shrinking for over a dozen years. And that's really reserves in the ground.
Yeah. Another question I just thought, obviously, once the money does start flowing into those junior miners, what other challenges do you see the junior space facing, the gold mining junior, once they have more capital into that market? What other challenges do you see?
Well, this plays well to your profession, Rob, and that's the lack of talent. And unfortunately, there are way too many people in the sector that look like me, a lot of gray hair, and not a lot of runway left in our career. And so we need to replace human resources that are dramatically depleting. There's a wave of retirements coming in the sector, and the mining schools are not attracting the type of inflow of new young talent that we need to replace ourselves as an industry. So I think financial capacity will come back into the sector in due course as we start to see some momentum in the commodity price. But I'm not sure how we're going to replace, this generation of retiring executives, retiring mining professionals that'll be, taking their retirement over the next decade or so. So that's going to be a significant challenge for the sector is that human capital.
Yeah, and how do you see the industry trying to attract people? Man, what would you like to be seen? What could be done to attract people into obviously studying for various, whether it's mine engineering, whether it's geology? What are your thoughts around that? Well,
I think when the sector starts to more consistently have access to capital and investing in the ground and creating that dynamism that we had in the early part of the century when there was a lot of building of new mine capacity, that attracts talent. It's that dynamic nature of the industry where you're building, investing capital, raising capital. That's been largely absent over the last dozen years or so because of the inconsistent access to capital. In fact, investors have been demanding that capital be returned to them, that we deleverage our balance sheets, return capital, pay dividends, buy back stock with scant investment into new capacity. And when you're not growing, you don't attract young human capital. These are people that want to further their careers, learn. This is an industry that's been essentially harvesting itself out of existence for the last dozen years. When we start to invest back in ourselves and we see some conviction in the general equity markets in the sector, then you're going to start to see some of that human capital flow back into the sector as well.
Yeah, and hopefully that does happen. As we were speaking offline, there is a skill shortage in the industry, and there is a lot of older people retiring, and there needs to be more people. And even when I look on posts on LinkedIn, and there's a lot of people now bringing this to everyone's attention that there is a big skills gap, and that needs to close.
Indeed.
Yeah, David, really appreciate your time. Thank you for taking the time to obviously have a chat with us. If our audience wants to obviously reach out to you, if they want to follow some of your companies that you're involved in, how can they go about doing that? What social media channels, platforms are you on?
Well, I'm easy enough to find on LinkedIn, but if you'd like to learn more about my royalty vehicle, which is really my full-time day job, it's goldroyalty.com. So very easy to remember, and be happy to take email inquiries, or if you want to sign up to our newsletter, whatever you'd like. I'm delighted to hear from investors whenever they have an opportunity to reach out.
Yeah, that's great. David, all the best for the remainder of the year. Hopefully we can get you on next year, not leave it for another 3 years. And you can give us an update once that gold price starts rising and building momentum. So really appreciate your time. Thank you for listening, audience. Hope you enjoyed that. There's certainly a lot to unpack there. Gold is obviously an precious commodity in our world. So obviously, please take note. Please share this episode with others around the industry, not just people within our industry, but also people outside of the mining industry, because obviously gold is used for investment purposes as well. So really appreciate your time, appreciate your continued support. And until next time, happy mining.
Thank you for listening. Remember to reach out to Rob via the show notes and be sure to subscribe and leave a review. Until next time, happy mining, helping each other to improve the mining industry.